There's not a lot going on in the world today, so I'm sure I can cover this in 30 minutes. But what I will do is try to hit some of the major structural aspects of the way it might be interesting to think about the world now. And in the Q&A, happy to answer anything from China, the Iranian parliament, the whatever you want to bring up. I'm happy to go into it. It's fun, and occasionally I will say I have no earthly idea. Bottom line, starting off, I think the industry is going through, it's in the midst or in the beginning stages of a very significant shift. In the early 50s, 1950s, Harry Markowitz wrote Portfolio Selection, and that was the next big wave kind of after Ben Graham, and launched kind of what we have as modern portfolio theory. And everything we've learned with modern portfolio theory is a single period model, and that's the difficulty. It's only valid when you think about where we are today and the endpoint, the outcome, and the uncertainty associated with the outcome. And that served us well for many, many years, and there were good reasons that it served us well, which I'll get into. However, it's not going to serve us well in the world that we live in today. And what's so interesting about the world that we live in today is that we realize that path matters, that the world doesn't just stop between today and the end point. And the ability to process information and a huge breadth of information makes the analysis of that something that wasn't even fathomable back 50 years or so ago. I believe we're in the beginning stages of a kind of a new wave of portfolio management that breaks down the single period structure and ultimately moves toward more of a path-dependent type of thought process. It's been around for a long time. It's been thought about for a long time. Nothing really successful has been done yet in my mind, but I think we're kind of beginning to knock on the doors of some things that could be successful. So with that, hopefully some of those concepts, I just want you to think about that as I go through this. I'm not going to specifically talk about it, but that's the underlying message of the specific things that I'll talk about in terms of navigating the world that we live in today. I'm just so you know, I'm a macro investor. I couldn't pick a stock if it came up and whacked me over the head and said I'm really good. I don't invest in individual stocks or bonds in individual countries. I'm purely macro. About 125 different markets, sectors, equity, fixed income, credit categories, currencies, about 30 different currencies. That's my playground. And those are the things that we look at as an investment team. And we look at them exactly like you'd look at anything else. Our approach to the topics is as a single company with cash flows, and we discount those cash flows to determine what the value of the S&P, the topics, whatever it may be. So that's the way we approach it. I'm purely macro in nature, global in terms of portfolio management, so that's kind of the type of thing that I'll hit on. So I kind of hit on that. So first, what I'm showing you here is just a chart of the S&P 500 in blue. In green is inflation, and in kind of red burgundy is the return to real return wealth index to the 10-year Treasury. This goes back to 1900, so I've got the data here from 1900. I could have gone further back, but it doesn't really matter doing that. And when you look at that chart, it's basically I want to focus on equities right now. But the equity, you'll notice that often Jeremy Siegel will show this chart, and you'll draw a straight line through it and say, you know, stocks for the long run. And I think the Dow will be at 3,600 sometime soon. Somebody got that joke. Good. You're older, you might get that reference. So somebody got that. But anyway, it's interesting. I chose not to draw it that way for a reason. I chose to pick it apart and say that there are two major segments. That the first portion of that from 1900 to 1950, somewhat arbitrarily. It has one growth rate or one real return, and from 1950 to 2000 has another real return, and then we are in an environment today that is what we really want to think about. Why would I have set aside the middle part or the latter half of the or separated the first half from the last half of the last century? What was going on in the last half of this last century that was unique? What would have made returns be somewhat unique in that environment? Anyone take a guess? Infrastructure. Yeah, I mean, the highway system coming into play was clearly an important factor, and I definitely can't say no. I think that's definitely a big element of it, and it's kind of what China's going with today in terms of productivity. So the answer is that yes. No one's ever said that, and damn you. So no, it is. It's just not one of the two I was looking for. So no, you're wrong. No, it is a good one, and in part we can ask also why was it even feasible? Why did that come about? And that's an important aspect of thinking about the prior half. What else was going on over that period of time?
Digital revolution.
It started, yeah. I mean, Watson was out there and doing some things, and I actually remember going to school in 1978 and programming on an IBM System 370 assembler language. So that goes a long way back. So I'm not sure I could take that all the way to 1950, though. Globalization, baby boomers. Well, I'll keep going. Demographics. Cold War.
Productivity growth.
I'm sorry?
Productivity growth.
Productivity.
Education.
Gold standard. Education. I'm sorry? No world wars?
Declining interest rates?
Declining interest rates. No, because that was going up until 1980 and then down from there. And I think the Maley bond, the 14 and a quarter. I'm never going to finish this if I keep doing it. I'll never get past this page. And the two answers I was looking for in there that are differentiating from what we have today were among the comments that were made here. One's demographics. The baby boom started in 1946 and ended in 1964, I believe it was. And I'm on the last half of that, and I can tell you I hate every single person in the baby boom because if you are older than I am, you went out and you bought houses all around the world and made them very expensive for people like me. Then you went in and got jobs and literally choked the job market with middle management and kept me suppressed at the bottom. I guess I broke through, but you were the barrier, and now you're making retirement really a pain in the ass, okay? I'm really not, I'm trying to buy a retirement home, but you've already bid those up now, so you've got me twice on housing. But the baby boom was one, and the baby boom was important because there are only two things that define growth, and that's productivity and demographics. And there are many things that lead to productivity. Obviously, the highway system was a phenomenal development, which I should have thought about, so I'm really kind of licking my wounds here. Sorry about that. But the demographic element was a huge advance in the workforce. And that huge advance in the labor force throughout the developed world was able to push a faster rate of growth and higher returns to the equity and bond markets. Assets are just claims on the underlying economic engine. That's all they are. Slice and dice it, buy a claim, that's called an asset. That's all it is. So when growth is higher, over the long run, you'll see that reflected in asset returns. The other thing that was going on over that period that I found interesting was the Cold War. There were no wars, in effect. The Cold War, mutually assured destruction is astoundingly stable. It's not necessarily the most comforting thing in the world, but it's astoundingly stable. And the odds of something happening are very, 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 very small. And all engagement proves to be proxy. Vietnam, Cuba, never direct because you don't want to end up getting in that type of situation.
Nothing personal.
Yeah, look at that. That's fun. Uh-oh. Okay. So anyway, it's really stable, and in a stable environment, resources can be allocated more efficiently. It's a little bit, it's an environment where you can understand potentially what the future is. You don't have geopolitical instability, which was the hallmark of the prior half of the century, making those types of investment decisions difficult. And you can invest in things like the highway system, but many other things you can do from an investment perspective to boost productivity. Now, when you think about investing today, when you think about navigating today, what I believe you have to do is consider as the analogous period, the period from 1900 to 1935. So if you really want to understand the world we live in today and think about macro investing, that's what you need to be studying. You don't need to be and shouldn't be crunching data all over the place because it's all only available since 1944 when Kuznets developed the GDP accounting, national income accounting system, and when various people began to run some data, collect data on equity markets. It didn't really go back. When I was in the industry, it was really hard to get anything prior to 1980. That was about it. And that's the data that people look at, but it doesn't reflect the reality of what we live in. And why do I say the period back then is interesting? Well, first, central banking was new. The Federal Reserve founded in 1913. Yes, the Bank of England was around and things like that, but it really was a path-breaking creation with the Federal Reserve with a lot of different aspects to it, and there was a lot of exploration and learning that was going on exactly like we have today in today's world. Obviously, the geopolitical environment was unstable, and it's unstable with many of the same entities that we're seeing today out there around the world. We always like to think that the U.S. is polar. It is polar. You can actually go back and look, and I have, at every single vote from every single representative and senator from the first Congress till the current, what is it now, 115? Something like that. Literally look at every one and determine how spatially different they are on the issues. And what we find that today we're very polar, mostly the House. The Senate is less polar. Back then the Senate was more polar and the House was less polar. So it's not as if we haven't been through this before in terms of political polarity. Debt levels. The world was suffering, the developed world was suffering through high debt levels. Just to give you an example, British debt at the time, when at 1900, went from about 30% of GDP to just over 200% of GDP as they got into the mid-30s. And that's the type of numbers that we're talking about today. Reinhardt and Rogoff are saying 90% is the breaking point. They survived it, I guess, in the UK. And then trade. Trade was also under threat at the time. I don't know if many of you remember Smoot-Hawley, the Smoot-Hawley Tariff. You've heard of it? Okay. It was a tariff that was put in place, envisioned in 1929, put in place and passed in 30. It was only around for 4 years, and global trade collapsed. As a contributor to the Depression, we all talk about monetary policy and restrictive monetary policy, which is why Milton Friedman got the Nobel Prize. But that was absolutely just a self-destructive maneuver introduced by the U.S. by two men called Smoot and Hawley. So I always like to say their names to make sure they're tagged with that one. And then finally, and most importantly, the Cubs won the World Series back then, and we just won it again. So in 1908, so yeah, right. So that's yet another thing that's going on. But the point of it is we're seeing a lot of things that we saw back then around the world. And you don't want to think of this higher growth period as being the norm. You want to think of geopolitical instability. It's not different this time. It was different that time. Now we're back to normal. This is the world as it exists. We're now investing in the world as it exists, and we don't have any experience doing it, unless I don't think anybody in this room does. They're not quite that old. So the things that we have to think about when we navigate now, oh, yeah. I'm camping, too. Yeah, I think I got it. Navigate right now that are important are central bank activities. Bill Gross referred to it as a casino. It's not a casino. Fundamental managers, which take CFA, a lot of you end up being a fundamental portfolio managers, have struggled mightily since 2008. Not unexpected. Not unexpected because central banks are manipulating interest rates. When you're manipulating interest rates, you're manipulating the discount rate, you're manipulating asset prices. What's a good way to define an asset? It's the only thing that can be priced as a price and an interest rate. And they're in manipulating asset prices, they can't go back and equilibrate toward fundamental values. And that has kept prices away from fundamental values for the period of time, the last 10 years, basically since the global financial crisis. We actually have a measure of that we work with on the team, and it's important. But right now, we're beginning to see that logjam kind of break up and beginning to see an environment where the things that we actually learn from a valuation perspective might be a little bit nicer to us. Populism. I know everybody talks about populism these days. I was out with my dog walking this morning, and while she was peeing, she was talking to the dog next to her about populism, and I was a little bit surprised, but I think at that point I realized that maybe it's priced into the market. It's kind of like the taxi driver telling me to buy tech stocks. The populism for us became an important thing actually in February of 2010. That's when we first kind of identified it as a macro theme. And it is not going away, and it's not going away because of the baby boomers again. The developed world basically is a world where the social contract that has been entered into by populations is not going to be delivered on. It can't be delivered on. And the realization is that there's a whole class of society that simply hasn't participated and hasn't been able to participate in this and has a liability burden on their back that they don't want. And they are rejecting what's out there. And if to give you some sense of that, at the end of this century, Germany's population will be what percent of what it is today? So today, it's 100% of what it is today. What percent do you think it'll be at the end of the century? 125%, 100%, 80, 65, 70, 85, 150, 50. 50%. Italy, 50%. Spain, 50%. Japan, 50%. I'm rounding these. U.S. is in great shape, 100%. Now, the point of that is that things will change. They absolutely will change. The system, the social welfare system that exists there is simply not viable when you have a population that's 6 years, median population age that's 6 years higher than it is right now at the end of the century and only half the population. It's just not going to happen. And what you're seeing now is the first movement toward resolution of that problem. Populism we look at as a bad thing. Brexit we look at as a bad thing. But these are the things you're going to live with as we resolve this issue. And what we're moving toward is hard to actually identify how it will happen, but it is not necessarily difficult to identify what will happen. And the what will happen is under the category of people respond to incentives. The rest is commentary. And the incentives are, and will remain between now and then, a march toward free flow of goods, services, capital, and labor across borders. Because if goods, services, and capital travel freely across borders, you do not need to have a population that is 100% of what it is today. If labor can move across borders, then you can have a population that's somewhat different. Now, we may be seeing the opposite throes of that right now. Does that mean I have 35 minutes or 8 minutes? So in the midst of all of this, that's what we need to be looking for. That's what we will see as the incentive. That's what, and this is what's important, determines fundamental value. And what we do, and what I think investors should do to navigate this world that we live in today is look at which countries are actually adopting institutions that are supportive of the creation and ownership of wealth. And those are the ones that will have high growth, high cash flow growth. The others will ultimately observe wealth destruction and declining asset prices, and those are the ones that ultimately the fundamental values and growth rates will be relatively low. And the populist rejection right now is simply a rejection of what we have right now. We know we need to turn, but the key with populism is populism stands for, it doesn't stand for anything. It stands for absolutely nothing. It stands against something. And that's all. It stands against the established. It can be Occupy Wall Street. It can be Arab Spring. It can be Donald Trump. It can be Brexit. It doesn't matter. Brexit, don't want Brussels. It's all the same thing. It is not unique to the U.S. And it's why it can be Bernie Sanders or Trump. It's why it can be Marine Le Pen on the extreme right in France, and in Greece be Alexis Tsipras on the extreme left. I think I wrote Le Pen, right? Did I get that right? Sometimes I. So those are the things going on, and that's what's going to have to be navigated. But the realization is this is a convulsing process of moving toward where the incentives are ultimately driving us in society, and it's going to be difficult. Places like Japan are so culturally unique. Japan, I always like to say, is the only country that is its own civilization. I can't think of any other country that's its own civilization. Labor migration will not be the solution to their problem. It's just culturally not feasible. They do have things they can do on the labor side with the female workforce there, but that's a cultural issue that's going to take forever. So they then have to focus on the free flow of goods, services, capital across borders. And this whole concept of twin deficits, a trade deficit. The best of the world will be when we have massive trade deficits and massive trade surpluses, because that's reflective of the free flow of goods, services, and capital. And I guarantee you nobody gets up in the morning in Florida and says, oh my God, we've got a massive trade deficit with the other 49 states, because we're a bunch of old retirees who are doing nothing but consuming and importing everything we can import, but not producing anything. We're just shipping our capital abroad. Does not matter. When there's free flow of goods, services, and capital, you don't have to worry about that, and that's the point. And that's ultimately where the incentives push us. Geopolitical uncertainty, I think it's well known out there as an issue. I would say that the CFA doesn't teach anybody anything that's remotely useful in navigating that. That's called game theory. And if you want to be able to navigate a strategic negotiation, which is what politics or geopolitics is, there is a whole branch of study about that. You study something, finance, to learn how to value something. You study game theory to learn how to navigate geopolitics. That's the world we live in today. Sooner or later, it's going to be part of the curriculum. It's not going to be the old math crap that I had to learn when I was in school. There are many ways to set up a framework that organizes the information and focuses your attention on what's important. But as you go through this period of time, this very dynamic period, value's out there. Price is going to get to fundamental value sooner or later. But if your clients fire you halfway through, you've not acted in their best interest. And now we're in an environment where fundamental valuation, which when I got in the industry as an asset manager in 1990, it was necessary and sufficient to do fundamental valuation and be successful. You could sharpen your pencil a little bit better than the next guy or gal and do well. Now it's necessary, but it's not sufficient. I'm surprised. I'm only got like the second slide. I'm not getting anywhere through these slides. And then finally, we're going to witness the breakdown of the institutions that were put in place after World War II. The World Bank, the IMF, both coming out of Bretton Woods in 1945. The EU in 1951. Anybody know what the 5 minutes? Anybody know what the EU was originally? What was it originally called? What was it? ECB? No? The European Coal and Steel Community. I had forgotten that until recently, but something there that popped in. But anyway, that came about. GATT, the Global Agreement on Trade and Tariffs in 1947. Now it's the World Trade Organization, the UN, 1945. Let's face it, the AIIB, China's version of the World Bank, is considered to be superior in terms of governance to the World Bank. They don't give a rat's patootie about what the West agreed to after World War II to manage our culture among ourselves, or as some would like to say, Madeleine Albright likes to say, keep the Russians out and the Germans down. She's smarter than I am. I figure I can quote her. And to to transport our culture outside of the West. And the world just doesn't work that way. In the Cold War, in that stasis, it could survive that way. They don't care. India doesn't care. China doesn't care. They'll create an alternative to the World Bank. They're just as happy to get rid of the World Bank as anything else. That's power. They want that power. That's what the world's about. Those are the moves that are going to be made. It's not a friendly world out there. You want a friend, get a dog. That was the old Wall Street thing, right? And that's the way the world is. So as we go forward, I'll kind of tie things up with 3 quick slides. What do you think growth, I'm going to ask you to raise your hand. What do you think growth will be? Real growth for the last 100 to 150 years globally has been about 3.5%. Real growth, 3.5%. Now, what do you think it will be, let's say, for the first half of this century to 2050? What's your best guess? Will it be, and I'll just raise your hand, 1 to 2%? 1 to 2%. That's maybe 30-ish, 25%-ish, 30. 2 to 3%. About the same. 3 to 4%. Oh, we're dropping off the face of the earth here. Okay, how about 4 to 5? Who are the real optimists out there? Okay, so this is real growth going back to 1870. World real growth going back to 1870, and just notice these 2 lines. They're not quite the same, and there are projections out here that I got from various international organizations, countries, companies. Actually, if you really want interesting long-term forecasts of growth, the airline industry does the best, beyond a doubt. It's absolutely astounding what they do. And the point of this is you go back 3.5%. You can look back at the early portion, 1990 to 1935 that I mentioned, World War II, World War I, Great Depression. Other than that, we're beginning to see that type of volatility now in the less geopolitically stable world. And here's the great moderation, that period of time, which we're probably not going to see again. But when you look at these forecasts, what's interesting is, and I absolutely believe is the case, is that they're looking at 3.5% for the coming decades, or maybe 3.25. It comes down just a little bit. It was a little bit above 3.5, a little bit below 3.5. Comes down about 25 basis points. And the reason that I think is viable is something, you all hear about secular stagnation, and that always causes people to raise their hand to low growth rates. All the stuff on secular stagnation really pretty much pertains to the U.S., and if it's expanded in terms of the research, it talks about the developed world. But that's not necessarily the right thing to do, since 83% of the world's population lives in the developing world. I know there's a way. There we go. So the last 2 charts I'll come to here. This is down here, the portion of world GDP that is coming from the developing markets. And this is the portion coming from the developed markets. And it goes from about 17-18% up a little bit above 25%, I believe was maybe 30%. I'm sorry, about 30% out here. So it's still relatively small, but that's not what's important. What's important is how much it contributes to world growth. And that's what the emerging markets now contribute to world growth. It's gone up from about 25% to a little bit better than 50%. And that's kind of what we need to think about. And that is a world that doesn't want to be separated from the rest of society. It's moving very aggressively through a number of institutions, trade agreement. Oh, yeah, U.S. 1985, we entered our first free trade agreement. Who was it with? Yes. I'm sorry? South Africa? Come on.
South Africa.
South Africa. No. Canada? No. China? No. Kenya? Man. Yeah, you're right. No, you're not right. Kenya? Djibouti? No, that's not right either. That's not right. Israel. It was Israel. And now the world has about 400 or so functioning regional free trade agreements. The World Trade Organization has over 195 countries in it. We're going through a period of time where there's nationalist tendencies thrown up in the air, but they don't seem to survive once they actually get into office. It's a lot harder to implement once you realize how many jobs it's going to cost you to kind of pull it away from those things. But this is where we'll see the free flow of goods, services, capital, and labor across borders. This is where you need to look to understand which of these countries are adopting institutions that will allow that to happen, because that's where fundamental value ultimately is. And those are the things that, from my perspective, lead me to say I'm optimistic, not pessimistic, in the sense that I think real growth will stay around 3.5%. I think the world's economic engine will just chug along at that for many different reasons. I believe that innovation right now, as we have it, is probably the best thing we've seen, maybe probably even better than the Industrial Revolution in terms of productivity that's coming down the line. I keep going on tangents. I swear, just one quick tangent, and then I'll bring it to a close. It's interesting that one of the things that comes up that economists love to study is the fact that a disproportional percentage of patents in the United States, in any country, come from immigrants. And the question is why that happens. And nobody knows. But the current kind of running hypothesis is that what you have is an individual with a frame of reference for the world, a world view that is culturally determined, educationally determined, and they come to another country and they see everything and they can understand everything, but not in the same terms that I understand what happens in the United States. And they see things just simply differently than the way we do. And seeing things differently, that cross-pollination, ultimately the hypothesis is leads to different insights. And what's important about that is the cross-disciplinary element. It's putting that person into another system. It's not having them sit in their own system. And the one thing that is so interesting about the world today is the explosion of cross-disciplinary activity and the explosion of cross-cultural activity, and it doesn't have to be done in the same way it does. Every university is coming up with multidisciplinary centers to study this, that, the other thing, and that's the most powerful source of innovation that I see kind of looking out there today. So anyway, not too negative. Bottom line, I like to think of the world as tides, waves, and ripples. You want to ride the tides, that's fundamental valuation. You want to navigate the waves, and you want to ignore the ripples. The problem is the waves these days in a geopolitically unstable world are quite significant. You have to watch what the central banks are doing. You have to watch populist movements, which will continue, I believe, for decades. Geopolitical developments through a game theory lens is probably the only way to tackle a lot of that. And then watching the Western world kind of reconstitutionalize itself in terms of its institutions and integrate institutions on a more global basis around the world. I think that will be quite important. And in the end, from my perspective, it's really the world's going to be tapping into growth, new growth sources as the world grew off of the United States over the last 200 years of just explosive growth. That lifted a lot of the world up. And that's the type of thing that can happen as we go forward, and realizing that our demographic issues in the developed world are so extreme. I used to put a quote on every single one of my emails, and it was a professor at Rochester University, Steve Landsberg, and it was, economics can be summarized. Does anybody have a PhD in economics here? Anybody? I'm sorry because I'm going to give you everything she knows from her PhD in just a few seconds, and you didn't have to pay anything for it. Economics can be summarized in 4 words: people respond to incentives. The rest that you learn is commentary. And I do firmly believe that, having spent a lot of time studying economics myself. I just believe that the opportunity cost of the PhD was a little too high, so I didn't go quite all the way there. But anyway, that's kind of the thought process that I have here. I'm not negative. The engine is still chugging along. It's just chugging along in places we're not used to looking at. And with that, I'll stop and answer any questions that anybody has about anything out in the world today. Yes?
So I have two unrelated questions, since I raised my hand.
I'll give you unrelated answers.
Yeah, good. Perfect. Thank you. So one is that I would like to know what you are over and underweight from an asset class perspective, which I assume would be for the next 6 months to a year, not secular. So overweight and underweight, which will tell us, what you think is the place you want to put your money. And then the second one is on your productivity. Why has productivity been so low now, and where is that productivity increase going to come from in the next 6 months to year and a half? Not, again, long-term secular emerging market, people want to do better stuff.
Yeah, I'm drawing a blank on the economist who said you can see, was it Schiller? No, it wasn't him. You can see productivity everywhere except in the data. And the reality is we don't know if productivity is actually declining. We don't know.
Repeat the question.
Oh, thanks. So what does the portfolio look like? What do you do with this? And why is productivity low? And we don't know. Nobody knows why productivity is low. However, we in the developed world have benefited from the evolution of our social institutions, rule of law, property rights, labor flexibility, trade and tariff flexibility, any number of things like this has been an important supporter, and we do a lot of research on those social institutions and the impact on growth. And what you saw over the last 50 so years and longer is a continual improvement of that throughout the developed world. And actually, in many instances, a decline in the developing world. It's always interesting to think when a lot of people left Germany in the early portion of the last century, they came to two places. The U.S., they came many places, but interestingly, there was a choice coming this direction of the U.S. and Argentina because it wasn't actually clear which one would be the real powerhouse going forward. U.S., just larger and everything, but that's kind of a sense of what was going on in Argentina. At the same time, the social institutions there were not put in place, and it didn't actually occur. Second thing is that it's a measurement issue of great degree that just puts massive uncertainty around the numbers. We don't know what real GDP is. We know what nominal GDP is, and we go out and we wave our finger in the air to try to figure out what inflation is doing. But what do you buy? I mean, if I buy a light bulb, am I buying lumens or am I buying a light bulb? And if I could have bought, million candle power, a million candles, in the past to get a million lumens or one big spotlight, spotlight that's a million lumens, it's going to be a lot cheaper than a million candles is going to be. And they try to do what's known as hedonic adjustment, and they're just abysmal at it. Not that they are not good economists and researchers. It's just moving too fast, and there aren't enough people in the BLS, et cetera, to actually go through that process. What that means is the bias in measuring inflation to subtract from nominal GDP to get real GDP leaves you with something that's, who knows? And that's a big problem in actually trying to back in ultimately into productivity. I think it's going down. We just really don't know when push comes to shove. There are lots of hypotheses, a lot of things to test, but haven't been able to really academically do much other than observe this case, and it may be related to this, it may be related to that. Portfolio, I have an almost wonderful slide. First, I just would want to just, from a valuation perspective, the tides. The blue are equity markets. These are expected returns over the next 5 to 10 years. Yellow are bonds. Green are currencies. We do obviously currencies. The blue ones, I'll just focus on the blue ones. The left one is the U.S. The next to the left, the second one is non-U.S. developed, and the third is the emerging markets, all hedged into U.S. dollar terms, so they're apples-to-apples basis when we look at that. So if we're riding the tide, you'd expect us to be long equities, but not long the U.S. We go long short, so we're happy to be zero, and that's what we are. And then with bonds, clearly unattractive. I don't think that's necessarily a surprise to anybody from a valuation perspective, so you'd expect us to be underweight there. And then this is a really, really cool slide. Uh-oh. Oh, it was taken out. It's in my hard copy, but it's not in here. Okay, so I'll just tell you. What I did, we go long short, but I built a 60-40 portfolio using ETFs and things like that, just to say, here's what it would look like if that were the constraint on us. What are our positions? It's astounding right now that downside tail risk compensation has gotten as high as it's gotten. Nobody wants it. Every time I go into a prospect or client meeting, the first thing I'm asked is, what do you do to manage downside tail risk? I don't know. I stay home and close the doors and go into the wine cellar and just get drunk. I mean, what are you going to do? You know, your job is to allocate resources. I'd like to make it not risky, but I haven't been able to find a way to do that. And cash under the mattress doesn't work either. That poor thing, inflation, just keeps eating away at that. And in the world that we live in today, then investors are just unwilling to take downside risk. And central banks, in manipulating rates through the portfolio balance effect, have pushed investors aggressively toward risky assets and away from low-risk assets. Well, once you've gotten your head and probably a leg or two, or maybe an arm and fingers cut off with the global financial crisis, you're probably behaviorally loath to take downside risk in that environment. And so what we observe is, or our narrative, our hypothesis, is that investors move to the least risky of the risky that they didn't think would give them the type of downside risk. And they felt that the snow was at the bottom. The avalanche occurred, all the snow was at the bottom of the mountain, and the risk was less in the U.S. Than it was anyplace else. So money has continued to flow into the U.S., ergo, its price is basically relatively expensive compared to fundamental value. It has fled the places where we invest. We like to tread where others fear to tread, and what that means is we own in Europe. Our largest exposure is Italy, Spain, France, and the UK. You pick the things that will burn anybody's hand, and that's what we do. As I said, it's about navigation. That's the new world that we live in. You can't just go out and buy those markets and wait around for fundamental value to come about. There was an election in France. You couldn't forget about it. There is a parliamentary election coming up. You can't forget about it. And it all hinges on one country, and that's Italy. Nobody cares about France. It's Italy that matters. And those are the things you have to navigate, however, when you invest in those markets. We're short Germany. We're flat, I should say flat to short the U.S. as well, a little bit. Flat to short a little bit Japan. So you can see how we've kind of got the portfolio position. Globally, long financials, long energy, but we pared back the energy dramatically. I don't know what people are thinking, calling for $80 a barrel on oil. It's just like, a lot of the forecasts are based on demand, and so that's just a bad thing to do because nobody knows demand. There's no measure of it. You just take supply, subtract inventories, and there go demand. And that's all they do. But the supply structure, supply elasticity for oil has changed dramatically. The whole game has changed there, and our equilibrium price of oil is relatively low. So today's a great day for us because this is the type of thing where we look at it and say, now we're getting to a place where we'd actually consider owning the energy sector, which has performed poorly anyway, regardless of what oil has done. So long utilities, but not in isolation because we are short some bonds out there, and there's long utilities kind of pair up nicely with financials and the bonds. So that's kind of the equity arena in Europe, and outside Europe, the emerging markets. Both the currencies and the markets themselves. We're long a number of them, in particular Southeast Asia. I'm not trying to hawk the portfolio here. I generally don't like to say anything about it, but I am happy to say what we do if you're interested. China, Malaysia, Vietnam are valuable ones. A little bit of exposure in Indonesia and India. We're short South Africa. We're short Mexico. We're long Brazil and long Argentina, which is an interesting one. That's a relatively difficult one to do. It's hard to get even a dealer to make a market in it, which is one of the reasons why we like it so much. And that's really the way we're positioned. We're generally short the developed currencies, the euro. U.S. dollar is expensive and a freight train, or has been for a long time. We're a little bit short that. and short the euro, short the Swissy, long the pound a little bit, long the yen a little bit, but mostly long some of the emerging currencies, short a lot of the commodity currencies, the Aussie, the Kiwi, and the Canadian dollar. So it's kind of what we are right now in the portfolio. Oh, bonds, I should say. Basically no credit, and in the portfolio just a little bit, and we're slightly short bonds on a global basis. The most important short, I'd say, is Italy. And that provides a hedge for the exposure that we have in the equity side if there's an event there. So that's a risk management tool for us. We're short that against long Germany, so we bought it against Germany as a spread. That's it in the fixed income world. So, yeah, that's it.
Thank you.
Any other questions? Yes?
Expound upon Italy, please.
Oh, yeah. Okay. So Italy. Populism and geopolitics. Unfortunately, those two are really nasty bedfellows, and they really come into play in Italy. So let's delve into Italy directly. The populist movement in Italy is the five-star movement headed by Beppe Grillo. He's a comedian, and as a comedian, he kind of ran a whatever campaign a number of years back in 2013, and didn't go on any debates, didn't do any advertising. All he'd do is stand up in plazas and say his stuff. But he polled recently as the highest percentage, that party in Italy, and they want out of the euro. Point blank, they want out of the euro. And so the population wants out of the euro, and the primary platform of the five-star movement is to get out of the euro. The PD is the alternative kind of mainstream party, and the PD is was headed by Matteo Renzi, and basically, Italy is the only country that you can calculate a mean and standard deviation for the number of governments they have in a year. It's an astounding concept. But they're at a situation now where they can't even constitutionally vote have a general election. So they are in the process of developing and proposing a resolution so that they can actually vote for the lower house and determine who their next prime minister is going to be. The thing is that with Beppe Grillo and the five-star movement polling as high as the PD is, higher than the PD is, if in fact he happens to win, then you have an immediate referendum to get out of the EU, and that's a country that wants out of the EU. And we say, okay, so you get out of the EU. There's something that's kind of obscure out there that's incredibly valuable to follow, and that's called target two balances. Has anybody ever heard of this? Target two balances. Oddly enough, it may be one of the more important things going on in Europe, and very few people know about it. I like to fish. I'm just going to give you an analogy of what target two balance is. This does all come back to Italy, I swear. Believe it or not, it does come back to Italy. I like to fish, so I go from Chicago to Texas to fish, and I spend way too much money on fishing tackle. So the money flows down there, and the Dallas Fed says, oh, look at this. Singer's been down here fishing again. We got the money flowing in. Chicago looks at it and says, yeah, we got millionaires leaving faster than any other state in the country. But Singer's down there fishing because we see his account as well. We're losing cash on that. And all the regional banks in the United States have that happening as funds flow around the United States. And once a year, they transfer securities to true up that flow that occurs. In Europe, the ECB is the monetary authority, and the national central banks still exist, and they are the lenders of last resort. So you've got split duties there. And Target 2 is the acronym for their basic balance system between the central banks, just like what I mentioned with the Federal Reserve regional banks. And if, for example, there's a capital flight, or I just simply want to move my money into assets in Germany, same thing happens. It goes to the Bundesbank, and it comes from whatever country I'm in. And the problem right now is that those balances rise and fall, and they rose really high during the crisis in 2011 and 12, in the debt crisis in Europe. They came back down dramatically, and they're back up even higher than they were then. Those balances mean that the Bundesbank is owed It's owed. It has an asset, and it is owed $750 billion, split about equally between the Italian central bank and the Spanish central bank. If the Italians decide to exit the euro, they are not just going to pay $350 billion to the Bundesbank. The Bundesbank would be insolvent with that hit. And there is no legal framework whatsoever to even accomplish this. Because it was never put in place. There was never any transfer of securities to align it. It just keeps building up. And as capital flees, it gets worse and worse and worse in that situation. So this is why Italy is so important. The French would never have left. The French don't even want to leave the euro. The National Front, or Marine Le Pen's party, would have put it out there as a referendum, and it would have failed. If Marine Le Pen had won, it would have breathed life into the populist movement. It would put wind in the sails, but she lost. And that took the wind out of the sails for populist movements around the Eurozone to some degree. The PD in Italy has moved up now neck and neck with the five-star movement. So now the five-star movement is dissipating in terms of its popularity from a populist perspective, and the populist party, the Alternative for Germany, is collapsing as well, leaving Merkel with a much more stable opportunity there. So we're getting a little bit of a downturn in the power and the wave of populism, and that's why Italy is so important. They're looking right now to pass electoral law that will be constitutionally acceptable. The discussions in the background are to make it a system more like Germany, the German system where there is proportional representation rather than a first-past-the-post system. If they actually are able to do that, it'll be an interesting situation because, like Spain was a number of years ago, they've never actually had to deal with the types of coalitions that proportional representation actually brings. So they're in the background right now trying desperately to form coalitions with each other to keep the five-star movement from actually making it to where Beppe Grillo or somebody else in the party is the prime minister and would bring that referendum forward. They have to have their election ultimately by May of next year. There is an attempt or desire on the part of Renzi and others. It's kind of funny how the five-star movement and the PD at this point both think they'll benefit from bringing it earlier. But they're trying to actually bring that election earlier into this year rather than next year. So it's one of those things we'd say is clear and present danger. And the discussion is that it would probably be better off if they actually had the parliamentary election cycle on exactly the same cycle that you have in Germany, which would be in, I think, September is when late September is the date they finally set for it. So that's what's going on. In Italy, from a political perspective, from a financial perspective, they basically just stepped up and sold the first big block of non-performing loans, which is opening a market that didn't exist before. That's incredibly important to have happen. And Santander bought Banco Popular, which is an interesting thing in Spain because banks are finally feeling comfortable that the regulatory environment they haven't felt. They would not buy each other. In this environment, the only way that banks can survive with high capital requirements is economies of scale. They know they need to merge. But because the supervisory authority, which was the SEC, had not finalized the supervisory regulations, they weren't going to buy each other. And it's getting to the point now where they can begin to buy each other, and that was a really big move from our perspective, having that acquisition in Spain. That means that the financial sector is across the Eurozone is poised to benefit from these developments, and the Italian market is more heavily exposed to financials than a number of the other markets. So that's a kind of a sector thread that moves through Italy as well from a cross-current perspective that is supportive, even though those banks are crap, but they're priced like they're crap. So, but they're viably attractive, and depending on how things evolve. So we're long. Did that get? I mean, I didn't know whether you were asking politics, economics, or.
All that. Thank you very much.
Okay. It's probably more than most want to know, but I highly recommend you take a look at Target 2 balances. The ECB didn't even keep track of them because they summed to zero, and they didn't care. Now they report it every month on their balance sheet. And Hans Werner Sinn was the academic who really first delved into it and understood it. And University of Osnabrück was the university that compiled the data, and it wasn't even available from national central banks. They had to go through trade data to get the information because it's capital flow. Some central banks had it, some trade data had it. They cobbled it together, and it's really interesting and valuable to see. We actually like investing in Europe when the danger is really high there, because when those balances are high, they can't afford to break up. And if they can't afford to break up, they can't afford to ride herd on the UK and Brexit, because all that's going to do is fan the flames of populism in Italy. If they fan the flames of populism in Italy, then they're just killing themselves by doing that. So it's a really interesting environment, but that's what ultimately leads us to being long all of those. Not necessarily calmly, but long all of them. Any other questions? Yeah.
Just expand on your views on China and the politics there, or lack of, and capability of being able to invest in that for 5 years or 10 years or 15 years?
Yeah. From a valuation perspective, China is attractive. A shares and H shares. We're invested in both small cap, large cap, A share, a full lot. Valuation-wise, it's attractive. The big issue there is growth and debt. And what's interesting about it, if you take the debt to GDP for China, it's not as bad as Japan by any stretch of the imagination. And frankly, the U.S., I hate to say frankly because it implies that I wasn't being frank before, so I'll take that back and say realistically the U.S. would die to be in the position, the debt to GDP position that China's in, because we have very high debt levels as well when you take private sector and public sector debt and unfunded liabilities, which they don't have unfunded liabilities because they don't have a social welfare network to the degree that we have. But our nominal growth is around 4%, and their nominal growth is around 7%. Now, granted, nobody really knows what it is. Clearly, they're making up the numbers, but it's higher than what we have. And the best way to get rid of debt is through nominal growth. And you inflate it away on the inflation side, or you real grow your way to be able to pay it off. And if you really want to be afraid of a country, go be afraid of Japan, not China. The other thing is I wish I had the numbers off with me, but we recategorized all the debt and said what's in state-owned enterprises, and the state-owned enterprises take that and characterize it as government debt, not as corporate debt. And what happens is you find a very large government debt load and a very small corporate debt load. So the debt that you hear about is often talking about corporate, but realistically it's state-backed debt. And that's leads to a lot of misinterpretation. It's manageable at this point. I wouldn't say it's easily manageable, but the interesting thing about monetary policy in China is we always talk in the U.S. about monetary operations, interest rates, and moral suasion. They've got a fourth tool, and that's they go shoot a banker. And they'll change policy when they do that. So they've got a little bit more powerful tools than we have. And they are making progress on it. They're kind of squeezing the shadow banking system out into the open. The regulations that are putting in place are making it so they can't really function at interest rates that are set and with the parameters that they have set. Those solely squeezing them out. From our perspective, we take all of that, and I think Michael Pettis, do any of you know Michael Pettis if you research China? I mean, I call him the Chicken Little of China. He didn't like that. He wrote a nice long 50-page blog post about that. But he did a wonderful job of pointing out the debt issues that were there. But he's been calling for collapse for, 12, 15 years now in terms of the debt situation. We think it's manageable. The other thing that is growth is actually there. The highway system that we put in place, they're just putting in place, connecting the West and the East. And what that does is you don't have to then bring all the people to the cities. You can actually have the free flow of goods, services, and capital to where the resources and labor is out in Western China. So all of those are coming to play. From our perspective, suggests that fundamental value is pretty good. They've got a party Congress later this year. We've been long under the anticipation that that would lead to stability. They can't afford to have a lack of stability going into that political process. So it's been relatively stable from our perspective. And we're long the Chinese yuan, but most of that is interest rate based rather than currency mispricing based. That kind of, so that's the economic view that we have. And there's a lot more to it, but I know I have answered every question way too long than I should have. So happy to chat about it afterwards, though. Any other questions? Well, thanks everybody. Appreciate it. Thanks for joining us.